Okay, picture this. 1955, that post-war vibe, and boom, Disneyland opens. Just completely changed the game for family entertainment, didn't it? Pure imagination.
Absolutely. A total landmark moment.
Mhm.
And it's kind of wild to think now, 70 years on, Disney seems to be at another one of those big turning points,
Yeah,
starting something new.
exactly. And that's what we're diving into today. It's not just looking back, it's about where Disney is right now.
Right. So we've gone through, well, pretty much everything. Their Q2 fiscal 2025 earnings report, what CEO Bob Iger said recently in Abu Dhabi, news articles, the investor call transcripts, the works.
Yeah, we sifted through it all. And the mission for you today is simple. Pull out the really important stuff, the surprising bits about how Disney's doing and where they're headed.
Basically give you the core insights without you getting bogged down in, tons of numbers in corporate speak.
Precisely. So let's get into it. The financials first. What's the big headline number for this past quarter?
Well, the top line, the revenue, it's
Yeah.
definitely positive, up 7%. So they brought in $23.6 billion. That's compared to the same time last year.
Okay, 7% growth. Solid.
It is. But what really jumped out, I think, was the income before taxes. That shot up significantly. We're talking $3.1 billion, up from just $0.7 billion last year.
Wow. Okay, that is a big jump. Suggests maybe some of their cost cutting or efficiency drives are paying off.
Seems like it, yeah.
Yeah.
It shows that profitability push is definitely gaining some serious traction.
And did that carry through to the overall segment profits?
It did. Total segment operating income was up 15%, hit $4.4 billion.
Okay. And for investors, the earnings per share. How did that look?
Big improvement there, too.
Yeah.
Diluted EPS was $1.81. Remember, last year was actually a tiny loss, negative 0 cents. So quite the turnaround.
And the adjusted number, sometimes that gives a clearer picture, right?
Yeah, the adjusted EPS, which smooths out some one-off things, was also strong, up 20% to $1.35. So whichever way you slice it, financially, they seem to be on pretty firm ground this quarter.
Okay, good overall picture. Let's break it down a bit. The experiences segment, that's parks, cruises, merch, huge part of their business usually. How did that side do?
Experiences had a strong quarter. Operating income there reached $2.5 billion,
Why?
which is about $200 million more than last year.
And where did that growth mostly come from? Domestic parks.
Yeah, the U.S. parks and experiences were a big driver. Their operating income climbed 13% to $1.8 billion. It was kind of a perfect storm, really more people visiting the parks and those visitors spending more money once they were there.
Higher attendance and higher spending. That's the magic formula.
It really is. Plus, the cruise line got a boost from having the Disney Treasure sailing, more capacity. And the vacation club did better, too.
Sounds great, but I think I saw something about expenses going up in that segment as well. Was that significant?
Yeah, you're right to flag that. While revenue was up domestically, costs rose, too. It was mainly tied to getting the new cruise ships ready, the Disney Destiny and Disney Adventure. Pre-opening costs, basically.
Ah, okay. So spending money now to make money later with the expanded fleet makes sense. How much was that impact?
They put a number on it, about $35 million in the quarter for those pre-opening activities. So an investment in future growth.
Got it. Now, what about the parks outside the U.S. International? Was it the same story there?
No, actually, that was different. International parks and experiences saw operating income decline by 23%.
Oh, really? Why was that?
They pointed specifically to soft results at Shanghai Disney and Hong Kong Disneyland, and they linked that to the economic situation in China right now.
Right. A reminder that global economics definitely play a role in their performance region by region. Okay, what about the last bit of experiences consumer products?
That part did well. Operating income from consumer products was up a healthy 14%, mostly driven by licensing, selling the rights to use their characters and stories.
And wasn't there a game involved too?
Yes. They mentioned getting a benefit from the launch of the Marvel Rivals game. Shows how strong those brands are, even beyond the movies and parks.
Definitely. So looking ahead for experiences, what's the vibe? Still positive.
Seems that way. They said bookings for Walt Disney World for the rest of this fiscal year are solidly above prior year, which sounds pretty good.
And that impacts their guidance for the full year, I imagine.
It does. They're now expecting the full year operating income growth for experiences to land at the higher end of their previous 6% to 8% range. So feeling optimistic there.
Okay, this feels like a good moment to pivot to the really big news, the thing that got everyone talking. a whole new theme park.
Absolutely. Huge news.
Yeah.
Bob Iger called it a great moment in their history, especially coming, like you said, 70 years after Disneyland first opened its gates.
And where is the seventh park going to be?
Abu Dhabi.
Huh.
It's a major move, obviously, expanding into the Middle East like this. Strategically pretty significant.
Abu Dhabi. Wow. What are they saying about the park itself? What's the concept?
Well, Iger's phrase was that it will be authentically Disney and distinctly Emirati. So the idea is to blend, the classic Disney magic, the stories, the characters we all know, with the local culture and heritage of the UAE.
That sounds like a fascinating blend. How will they achieve that?
They talked about using contemporary architecture, cutting-edge tech, but still keeping that timeless magic, trying to create really immersive experiences that feel both Disney and specific to the region. Modern, but magical.
Interesting tightrope to walk. And who are they partnering with on this? It must be a massive undertaking.
Yeah, it's a partnership with the Mural Group based in Abu Dhabi. It sounds like Disney handles the creative side, the design, licensing the IP, providing their operational know-how.
And Mural.
Mural brings the capital, handles the construction, and will manage the day-to-day operations on the ground. So a real collaboration playing to each partner's strengths.
Makes sense. Any word on when we might actually get to visit? Is there a timeline?
They haven't given a specific opening date yet. But Iger did say that Imagineering, Disney's wizards behind the parks, they're already deep into designing this large and very special destination. So it's definitely moving forward.
Okay, exciting stuff on the parks front. Let's switch gears to the entertainment segment. Movies, TV, streaming, another massive piece of the puzzle. How did that division fare?
Entertainment also had a good quarter. Operating income there grew by $500 million, reaching $1.3 billion.
Nice. What drove that? Theatrical movies doing well.
That was part of it, yeah. They highlighted the success of Thunderbolts, for instance.
Oh, yeah, I heard that was getting good buzz.
Apparently so. Iger called it the #1 movie worldwide, and, maybe more importantly for them, the best-reviewed Marvel film in years. That could be a good sign for the MCU going forward.
Definitely a positive signal for Marvel fans. What else is coming to cinema soon? Their slate looks pretty packed.
It really does. Yeah. For the rest of this year, you've got the live-action Lilo and Stitch, apparently, that's tracking really well with audiences already. Then Pixar's Elio in June. Marvel's The Fantastic Four, First Steps in July.
Okay, keep going.
Then Freakier Friday in August, Zootopia 2 in November, and the next Avatar movie, Fire Ash, in December. It's a heavy-hitting lineup.
Wow, and that's just this year.
Yeah, and they even teased next year, mentioning New Avengers, Mandalorian, Toy Story, and the live-action Moana films were all in the works, too. So the pipeline looks very full.
Huge franchises. Okay, let's talk streaming. Direct-to-consumer. Disney plus Hulu, ESPN plus SI. That's been the big transformation story for a while now. How's that progressing?
It's definitely showing more positive signs on the bottom line. Yeah. Streaming operating income jumped by $289 million, hitting $336 million in the black.
So profitable now. And subscriber numbers still growing.
Yep. Disney Plus and Hulu combined hit 180.7 million subscribers. That's up about 2.5 million from the quarter before. So still adding users.
And are they just focused on growth or also on making the service better, keeping people subscribed?
Very much the latter, too. Iger really stressed the ongoing improvements to the user experience, trying to boost engagement, how much people watch, and crucially reduce churn. Stop people canceling.
Makes sense. And is that integration strategy helping? Putting Hulu's stuff and sports onto Disney Plus S?
They say it absolutely is. It seems people are watching more and are less likely to leave when there's more content integrated into one place. And they plan to do more of that.
Right, the one app experience idea. What about ESPN specifically? There's a standalone ESPN streaming service coming, right?
Yeah, it's pitched as a big step. And the strategy seems to be heavily focused on bundling. They want to create a fully integrated experience if you bundle the new ESPN service with Disney Plus and Hulu.
So encouraging bundling to keep people sticky within the Disney ecosystem.
Exactly. And beyond content and bundling, they're also focusing on tech improvements, better recommendations, better ad tech for the ad-supported tiers, plus investing more in local content outside the U.S.
Okay, lots happening in streaming. Let's turn to the sports segment itself, mainly ESPN. Interesting picture there, right? Viewership way up, but profits down.
Yeah, that's the slightly confusing part on the surface. ESPN's primetime audience, looking at that key 1849 demo, was up a massive 32% in Q2. It was their most watched second quarter ever.
Driven by what? big events?
Yeah, NFL, college football playoffs, and the NCAA women's basketball tournament really boosted viewership. Huge numbers.
But operating income went down. By how much?
It dropped by $91 million, down to $687 million.
So why the disconnect? More viewers, less profit.
It came down to costs. They had higher programming costs because they aired more college football playoff games and NFL games compared to last year. That stuff isn't cheap.
Ah, the cost of premium sports rights.
Exactly. And there was also a financial hit, a write-off, connected to them pulling out of that VNews Sports streaming joint venture. So a couple of factors impacting the bottom line that quarter.
But presumably the advertising side of ESPN is still strong with those viewership numbers.
Oh, yeah, definitely. ESPN's domestic revenue actually grew 7%, and sports ad revenue specifically jumped 29%. They said the ad market, especially for live sports, is quite healthy.
Any particular sector spending big?
They mentioned restaurants and healthcare being strong advertisers. There are some challenges on the direct-to-consumer ad side, more about supply than demand. But overall, Disney's ad business is doing well. They expect ad growth to beat their initial forecasts for the year.
Good to hear. And the standalone ESPN streaming service, any more timing updates on that?
Still just coming soon, basically. They said pricing and tiny details will be shared, well, soon. So we're still waiting on the specifics there.
Okay, so pulling back to the big picture again, let's talk about their overall financial forecast for the rest of fiscal 2025. Sounds like they're feeling pretty confident.
The guidance they issued certainly suggests that. They've bumped up their adjusted EPS forecast for the whole year to $5.75. That's a 16% jump from what they achieved in 2024.
That's a significant raise. What about cash flow?
They raised that guidance too, now expecting $17 billion in cash from operations for the year.
And we already mentioned the experiences segment guidance being lifted to the high end of 6-8% growth.
Correct. So, yeah, the forward-looking statements definitely paint a picture of confidence in their performance for the rest of the year.
And how are they using some of that financial strength? I saw a note about share buybacks. What does that mean for investors?
Right. So Disney bought back $1 billion of its own stock in this quarter, and they're on pace to buy back $3 billion total for the fiscal year.
And why do companies do that?
Well, basically by reducing the number of shares out there, it can help boost the earnings per share figure and potentially increase the value of the remaining shares for shareholders. It's a way of returning capital.
Gotcha. One last point that seemed important, their focus on the guest experience, especially in the parks.
Yeah, Iger made a point of emphasizing that the guest experience is paramount. They apparently limit park capacity on purpose sometimes so things don't get too crowded and diminish the magic, so to speak.
So they're consciously balancing attendance levels with experience quality.
Exactly. And the idea is that future expansions are aimed at adding capacity without hurting that core guest experience.
Okay, so if we wrap all of this up, what are the main takeaways from this deep dive into Disney's Q2?
Well, clearly, strong overall financials for the quarter, that experiences segment, the parks and cruises, really powered ahead, especially domestically.
And then the massive news about the new park in Abu Dhabi, that's a huge long-term bet.
Definitely. On the entertainment side, streaming seems to be stabilizing and growing profitably, and the integration strategy looks like it's working. Plus, that upcoming movie slate looks potentially massive.
And sports, despite the quarterly profit dip due to costs, still commands huge audiences and strong ad revenue, with the direct-to-consumer launch still to come.
Yeah, it's a complex picture, but mostly positive, I'd say. For me, a couple of those aha moments were, first, that vision for the Abu Dhabi park trying to mesh Disney with Emirati culture. That's really interesting.
Yeah, what else stood out?
The confirmation that putting Hulu and sports content into Disney Plus is actually boosting engagement and lowering churn. That validates a big part of their strategy.
Yeah.
And just the confidence they seem to have in that theatrical slate for the next 18 months or so.
Right. So for you listening, if you wanted that quick but thorough update on Disney, hopefully this covered the key developments from their latest results and announcements.
Yeah, we tried to hit the highlights and explain what it all means without getting lost in the weeds. It shows a company really leaning into its brands and IP while navigating, a rapidly changing media world.
Which leads to a final thought, maybe something for you to mull over. Disney's been around for 102 years now. You think about that history, and then you see this big move into Abu Dhabi.
Yeah, it makes you wonder, doesn't it? What does this signal about where global entertainment is headed? And what kind of role will Disney continue to play in shaping that future?
How do they keep balancing that classic Disney appeal, the nostalgia, with the need for constant innovation and this ever wider global reach.
Exactly. It's a big question. Definitely something to think about long after this deep dive ends.